It is possible to adopt a contrarian stance when investing in the sector. There are three key characteristics that one should be mindful of: valuations, investor positioning, and economic outlook. Valuations and investor positioning within the broad tech sector and specific subsectors are areas investors should be mindful of. Near-term risks can be higher in tech subsectors that have elevated stock valuations and are owned by the majority of investors. On the other hand, there are opportunities in areas with more reasonable valuations and lower levels of investor allocation. For example, in late 2021, valuations were high across the broad tech sector. Investors that were selective and held value-oriented, lesser-owned stocks, while avoiding the expensive and well-owned parts of the market, saw their portfolios perform better. Another area to take note of is the economic outlook. While tech stocks do offer long-term structural growth, they can still be impacted by shorter-term changes in the economic and interest rate cycle. For example, loss-making high-growth tech companies, such as those in cloud computing or fintech, can be vulnerable to rising interest rates as their valuations tend to move in opposite directions with bond yields. Value-oriented and cyclical tech stocks are more resilient in a rising interest rate environment. History has shown that adopting a contrarian stance when investing in tech stocks can be a powerful driver of relative returns. Market sentiment has dramatically shifted over the past few months on macro worries. Many investors have turned their focus towards near-term profits, completely ignoring areas with durable growth and overlooking individual companies' business models and long-term margin potential. As a result, some stocks have been oversold by investors and are now undervaluing their long-term intrinsic value. High-growth software stocks, especially those focused on profitability, are one example. Concerns over rising interest rates have created selective opportunities in this area. We also think the outlook on the travel industry has become too pessimistic. Although inflation may reduce consumer spending in the near term, there will still be pent-up demand for travel and outdoor activities while consumers' finances hold strong. Online travel agents and payment stocks are thus potential beneficiaries. In China, leading technology platforms have been under pressure due to regulatory and macro issues for some time. Although things remain fluid, the overall situation is improving and opportunities are emerging in this area. On the other hand, there are few mispriced opportunities amongst mega-cap technology stocks, as these large companies are still well held by investors. There are few opportunities here compared to other areas of the tech market. Tech companies play a crucial role in the development of sustainable practices across industries. As we look beyond the pandemic, there will be increased governmental and regulatory emphasis on transiting to renewable sources of energy. Regulations are demanding higher efficiency as well as better safety standards in areas like manufacturing and construction. Tech companies can play an important role as they are a crucial enabler of better sustainability practices across industries. For example, the use of software in industrial processes, manufacturing, and resource businesses is a key area of growth. Electric vehicles are receiving increasing policy support from governments around the world in the push to develop less carbon-intensive forms of transit. Semiconductors are crucial components of electric vehicles. These are two of the many examples where the tech sector will increasingly be part of in the global transition to renewable energy. Besides that, the tech sector has historically had a better ESG ratings profile than many other sectors in the market.